Hello finance students, we're approaching week 2 here. It's Sunday, October 14th. I want to give you an overview of the week and some insights into the chapters. This week we look here, we have chapters 4, 5, and 6. We start to get into the financial ratios, the time, money, and value calculations, and also an explanation of the various rates of return and risk and how to calculate a beta. So first, with just looking at chapter 4, I'm looking here at page 106, and this gives a nice review of the different types of ratios. And analysts and managers use ratios to help them look at, hey, how are we doing over a period of time, trend analysis, and how are we doing compared to our peers, kind of a benchmarking, and how are we improving over the years? And sometimes ratios will be different for different industries, so we have to take them with a grain of salt, but they're a good way to measure our financial performance or liquidity. So they mentioned there like the firm's liquidity ratios. When you think of liquidity, how quickly can you convert to cash without loss of value? Operating profitability, how the management is doing, how it's utilizing its assets to produce profits. Then financing decisions, our use of debt and the return on equity, how we're doing for our shareholders, and finally the market value ratios. So what does the stock market view us, or the market in general? How much are they willing to pay for our price of stock relative to some baseline? So Chapter 4 you may have seen a little bit before from an accounting class, if you had it previously before, but it may be new to you. But just kind of read it slowly and just kind of each time just understand where they're getting these numbers from. So a lot of times you'll notice that they're pulling numbers out from the income statement or the balance sheet. So as you read this chapter, maybe highlight and go back to that income statement and the balance sheet to say, hey, where did these numbers come from? All right, chapter 5, this is kind of the meat and potatoes of this week. And what I've done is I put an example out there in Excel. It's pretty much gone through every example in the textbook. Now, I use Excel in this course to explain the time value money calculations. The one thing that I want to point out is Excel looks at it from like your perspective. If you go out and you invest money, that's a negative cash flow for you. And you should expect some positive future value amount. So for example, like a future value problem, if I invested $100, I would put in negative 100 for the present value. And if I did this for 1 year, I put in the number of periods of 1. And that would be assumed like an annual period. And then the payment I'd leave blank at 0. And then we'd have some future value amount based on an interest rate. Say it was at 6%. So I'm saying I invest $100 at 6%. 1 year later, the bank is going to give me $106. So that's a positive value of 106 that I would see in Excel. The ones that you're going to look at in this chapter with the 5 basic time value money calculations are the present value I just mentioned, the future value I just mentioned, the present value, what is something worth to me today, and then we're also going to have payment, number of periods, and an interest rate. So walk through this chapter slowly. Make sure you understand where they're coming up with the numbers. Also, I'll mention that they also have like future value of annuities and annuity due, and a present value of an annuity and a present value annuity due. The big difference with annuity due is that the payment happens at the beginning of the time period as opposed to the end. So if I were to invest $1,000 at the end of every year, for 20 years, that same amount, that's just a regular annuity, future value of annuity. In fact, you go a whole year without actually investing any money. But if it's a future value of annuity due, it says that, hey, that first payment that I put in the money to invest happens today. Okay. Last chapter we have here, and in chapter 6, deals a little bit with the relationship of how different types of securities have performed over periods of time. The stock market is obviously more volatile than a treasury security. But for the investor's perspective, or from looking at a company's perspective, we want to know from our investor's perspective what risk is out there. And especially this chapter, we're looking for the equity or stock. We'll look at something called the capital asset pricing model, which basically says I take the risk-free rate, which might be like a 10-year treasury, which pays almost nothing right now, and then the market return, and I compare that to I include that in a beta. So the true formula is the risk-free rate plus beta times the difference between the market return and the risk-free rate of return. That's something that you're going to have to kind of do for your paper eventually down the road is, hey, what is the required rate of return for an investor that buys this stock, what we call equity? Also in this chapter, you have a little bit about systematic risk and unsystematic risk. There's company-specific risks that we can diversify away as our portfolio gets larger, but we just can't diversify away the market risk. That's always going to be there. Last thing I'll kind of share in that chapter 6, let's see here. Oh, the beta. And I put an example out there in the Excel worksheet was with the beta. You'll see like chapter 5 in one worksheet, chapter 6 in the other worksheet. The thing I want to explain about beta, because this goes into the capital asset pricing model, is if you have a beta 1, say for Kellogg's, that means if the market goes up 10%, then Kellogg's on average, their returns go up 10%. And if the market goes down 10%, then Kellogg's on average goes down 10%. If you have a beta equal to 2, it says if the market goes up 10%, then your stock returns go up about 20%. But if the market goes down 10%, then your stock returns go down about 20%. So the beta 1 kind of represents the market. A beta higher than 1 would say there's more volatility, there's more risk associated with the market. So the investor's expected required rate of return should be higher too. But if you have a beta equal to 0.50, it says the opposite. If the market goes up 10%, your stock returns only go up 5%. Or if the market goes down 10%, your stock returns only go down 5%. So there's less volatility, so there's less risk for the investor. So, but I'll have an example with the McDonald's one out there to kind of show you how it was calculated. But that's a brief summary of everything this week. Do email me about the time value money calculations for the homework if you do have any questions, but try to walk slowly through the examples because those take some time to learn. And otherwise, have a great week, and we'll talk to you next week.